All right, so we're on chapter 2. We are going to review the accounting process, and a lot of this chapter will be review from Principles of Accounting 1 and 2. So let's get started and let's kind of talk about just the basic model of economic events. We have external events and we have internal events. Okay, the external events, they'll usually involve an exchange transaction with another entity. Internal events, they do not involve an exchange transaction with another entity, just internal to the business. Okay, so we have our lovely accounting equation, and just for the fun of it, we're going to quickly review those debit and credit rules. So here we go. Remember, we have assets equal to our liabilities plus, I'm going to do stockholders' equity because that's mostly what we're going to be talking about in here. We have our revenues and we're going to have our expenses down here up underneath there. Remember, stockholders' equity has all these different branches now. It has the common or contributed capital, we have retained earnings, and we have treasury stock. Okay. So remember that thing called normal balance. Normal balance means the side we expect increases to occur. So we expect assets to increase with a debit and decrease with a credit. And then remember, we cross that equal sign and it gets flipped. So the normal balance of a liability is a credit. So that means to increase a liability, we would credit it. Okay, remember liabilities, equity, and revenue all look the same because they are added to each other. Okay, on when we're in principles, we have that withdrawal account, but if we're a corporation, dividends get taken out of that retained earnings. But remember how just because just the owner withdrawing money decreased the equity, dividends being paid decreases retained earnings, which decreases the stockholders' equity. Okay. So then our expenses have a normal debit balance. So I don't really care how you memorize these as long as you have them memorized. Okay. Remember in the other one, we would have had that T account right there for withdrawals, and it would have looked just like that. Okay. So now that we have reviewed that, that should be permanent knowledge in your brain, but if it's not, I would make it really quick because you will not do well in this class if you don't have that committed to memory. Okay, so we have our basic accounting equation, we have resources and then claims to resources. Okay, I don't think I've ever actually seen it quite laid out like this, but it really does kind of make sense because even though stock shareholders equity has a whole bunch of stuff involved in there because just because like net income comes from the income statement, it still falls underneath this umbrella of shareholders' equity. Okay, remember the accounting equation has to balance. That's a little bit more difficult in an environment like we're in, trying to make sure that we have a debit for every credit. But most accounting systems will not let you record an entry that is out of balance. It can be wrong, but it will be always be in balance. Okay. So I really like this one, okay, and how it sort of breaks down all of this. We have the basic, and then we have all the expanded. Now remember, we do have treasury stock there, but it's okay. We just, I just want to make sure you remember that we have treasury stock there, okay? All of this, oops, never mind. All of this right here goes to the income statement. Dividends will go on the statement of retained earnings to get to that. So if you'll remember how we have to do the financial statements in order, we have to do the income statement. There's our income statement because then we want to push that net income into retained earnings and then dividends go there in that statement of retained earnings. Then we'll come up here to this and then that's your balance sheet. Okay, so I really like that slide. I think I'm gonna pull that over into principles because I think that would really help a lot. Okay, so we're going to go through some journal entries. We're going to go through them kind of fast. Okay, so the first one, we received $50,000 and issued common stock to an investor. So you can see they just have the accounting equation written out here. Increase the asset cash and increase paid in capital and contributed capital mean exactly the same thing. So don't get confused there. Okay, and then we're increased the common stock. Okay. And they did not make the journal entry. We're going to go ahead and do that. Okay. We are going to debit cash for 50K and credit common stock for 50K. Okay. There's probably going to be a slide where they do all of those, but we'll already be done and we can get through this a little faster. All right. So $40,000 was borrowed from a bank and a note payable was signed. So we're going to increase cash and increase the liability. So that means we will debit cash again for 40,000, but we're going to credit a notes payable now for 40,000. Okay. Next thing we're going to do, we're going to purchase some supplies. Remember, supplies is the asset. It is an asset until we use it up. Okay, so we will debit the asset account supplies for 3,000 and we'll credit accounts payable for 3,000. Whoop, just trying to not let that get out of my lines, but it did. There we go. Okay. So the next entry, we are going to pay $1,000 from that supplies where we bought the supplies. So we are going to debit accounts payable for 1,000 and credit cash. So a very common mistake that a lot of students want to make is they want to come in here and do something with the supplies here. Nothing's happened to the supplies. We still have the supplies, okay? We're just paying the bill now, okay? We did it on credit when we bought the supplies. We're not gonna, just paying the bill doesn't affect the supplies and how many supplies are still left in our cabinet, okay? All right, then we provided $10,000 to customers on account. And so we provided a service, but we didn't get cash. We got a promise for them to pay cash sometime in the future. So we will debit accounts receivable and we will credit service revenue. Okay. Now, they haven't underneath this umbrella of retained earnings. I want you to think about this. Service revenue goes on the income statement, right? Net income, net loss gets closed to retained earnings. So that's why they kind of have that little umbrella. I don't want you to get confused there. Okay. Then, number two, we incurred but did not pay utilities that cost $5,000 for operations in the current period. Okay. We will debit utilities, if I could spell utilities. I can spell, I sometimes just can't write. Okay. And we are going to credit, I'm just going to call it utilities payable for 500. That'll be the credit. Okay. All right. Then we're going to pay dividends to the shareholders. Okay. So normally this entry goes like this. We would debit the retained earnings and credit cash. Okay. Sometimes they will tell us to use like a temporary account called cash dividends. So they may say they may debit this account called cash dividends of 2,000 and then credit cash for 2,000 and then ultimately later on they would close that temporary account to the retained earnings. I think common practice is more to just send it straight to retained earnings. It's not like it's an entry that's happening every day that it needs to be accumulated in an account. It's going to happen a handful of times a year. They're not doing cash dividends monthly, probably at the most quarterly. Okay. All right. So now they're talking about debits and credits, but you already know debits and credits, and we just went through all of those and made journal entries for them. Okay. Remember this double entry system that we have. That's where the debits and the credits come in. I know sometimes debits and credits are kind of hard because we have all these other rules outside of the accounting classroom that have used our terms like debit card and credit card, so it gets confusing. In the counting classroom, remember debits on the left, credits on the right, debits on the left, credits on the right. Think of me as your debit and credit drill sergeant. Okay. It is just left and right. I think sometimes it might even be easier if we recorded it. If we just like replace these terms as left and right, I think maybe the debit and credit would actually be easier. So think of left and right. Okay. A debit is not good nor bad. Neither is a credit. Okay. It's just left and right. An entry could be good or bad. Okay. But just definition, a debit being bad or a credit being bad, none of the above. Just left and right. Okay. We use a lot of T accounts when we're teaching accounting because they're easy to see. They're just a very good tool to understand things. Now, when you get out in the real world, you're going to make those journal entries into a system, and then that system's going to put it wherever it needs to go. The thing you need to realize is a lot of people, when they're doing adjusting entries, they'll draw the T accounts out on a scratch piece of paper that will help them be able to do the adjusting entry. So just because you're not necessarily going to see like a lot of T accounts when you're working your big adult job, but you might take a piece of paper and write the T account out to understand an adjustment. Okay. So here's our T account, debits on the left, credits on the right. I've already gone over the normal balance rules, but I like this. I've never seen a slide like this one either. I thought this was really neat where the normal balance of assets, expenses, losses, and dividends are really a debit. Okay. All of the liabilities, paid capital, revenues, and gains, those all have a normal credit balance. So this might be my new favorite debit and credit rules. Okay. All right. So we've already made all these entries. I debited cash, credited notes payable. Oh, that was just the example. Okay. Love this. That was that expanded equation into T accounts. This might be my new favorite slide. I keep saying that, don't I? So there we have our assets. Remember, we cross over to our liabilities, and they have a normal credit, and shareholders' equity has a normal credit balance. Okay. The paid in capital and retained earnings, they both look just like the shareholders' equity. And just so you don't get confused, I'm going to go ahead and add treasury stock in there because treasury stock is a contra equity account. Okay. Contra equity account. So it will actually have a normal debit balance because it's going to ultimately make stockholders' equity go down. Okay. Our revenues and gains, normal credit. Expenses and losses has a normal debit balance. Dividends have a normal debit balance. But really, maybe this would be that temporary account that would ultimately be closed to the revenue, to the retained earnings. Okay. So here are the steps in the accounting cycle. Okay. I drew these out. I wrote these out for you in Principles of Accounting, like the first four chapters. I had this wrote out. Mine was just a tiny bit different. I think mine had less steps. Um, but I like how they've broke this out between the different phases. So during the accounting period, I don't think I ever did this step one. My step one was always record the journal entry. Okay. So really, my former step one is 1 through 3. Okay. Then posting those journal entries to the ledger accounts, which all of y'all are in accounting information systems right now. That happens simultaneously in QuickBooks. Okay. Any kind of accounting system, when you make the journal entry, it automatically gets posted. So that's a double work that you're not going to have to do. We do it in this step because we're doing it by hand and we want you to understand it. Okay. Then the next phase is everything that's going to be at the end of the accounting period. Okay. So remember, we had that unadjusted trial balance. And remember, we had that worksheet. We might pull up a worksheet here in just a little bit. That worksheet had the unadjusted trial balance. Then it had a column for adjusting entries. Then it had an adjusted trial balance column. And then remember, it got split out between balance sheet, owner's equity, retained earnings, and income statement. Okay. Which are what? Financial statements. But the numbers in the column to the financial statements, that's not necessarily the financial statement. It's just pulling them out separate in that worksheet. Okay. Once we prepare the financial statements, then we're going to close all those temporary accounts. Your temporary accounts are your revenues, expenses, and I would say withdrawals, but this we're looking at stockholders' equity. So that would be dividends. Okay. And then they want you to do a post-closing trial balance. There is really absolutely no point whatsoever doing a post-closing trial balance, okay? Because if you look back at that accounting equation, let's go back over here really quick to where I had my debit and credit rules. All of this gets closed into that shareholders' equity. Well, once they do that, these three accounts are your balance sheet, right? Basically, your post-closing trial balance is just balance sheet accounts. It's just assets, liabilities, and stockholders' equity. But I think sometimes they throw things in there like that just to confuse you just a little bit more because you don't have enough confusion going on in intermediate accounting. Okay. All right. So I'm gonna go past these because we've kind of already talked about them. So I'm not gonna spend any more time on that. Here's a really good concept check really quick. Temporary accounts would not include, I just told you, revenues, expenses, and the dividends are the temporary accounts. That's a temporary account. That's a temporary account. All of the answers correct is not it because those two are temporary. Accounts receivable is the only one in that list that is a permanent account. Okay. So here is all of those transactions. Not all the ones. We didn't do all of them, I don't think. No, these are different. I'm so sorry. Okay. These are different and they're going through each one of these and going to make journal entries. So I'm going to stop for this video and I will pick up on the next video going through these journal entries for this problem.